Everywhere you look, people are talking about recession. They're feeling pessimistic. But there's one voice, Tom Lee over at Fundstrat, who's saying something completely different. He's making this really bold call that the bull market isn't just alive, it's got a long way to run. So today, we're going to dig into his outlook. We're going to break down exactly why he thinks U.S. markets are set to take off, even when so many people are betting against them. All right, so here's what we're going to cover. First, we'll tackle why this is like the most hated rally ever. Then we'll look at the 6 major stress tests the economy has just sailed through. After that, we dive into the big stuff, 2 huge tech supercycles, AI and blockchain. We'll even touch on a, let's say, interesting political reason for all the negativity, and we'll finish up with the real cost of just sitting on the sidelines and waiting. Okay, so let's jump right into the big puzzle. The market's hitting all-time highs, right? But nobody seems happy about it. Why are investors so incredibly skeptical right now? I mean, think about it. Usually when the market's on a tear, everyone's popping champagne. But not this time. It feels like there's this huge gap between what the numbers are saying, all-time highs, and how people feel. And that feeling is, well, it's pretty negative. But here's the crazy part. That deep skepticism, it's actually a sign that this rally might have a lot more room to run. And this isn't just a feeling, we've got the data to prove it. Check this out. For 5 straight weeks, while the S&P 500 was breaking records, there were actually more people saying they were bearish than bullish. I mean, that's just wild. It's completely backward, and it really shows you just how deep this pessimism goes. And what makes all this doubt so strange is that it's completely ignoring how incredibly tough the economy has proven to be. I mean, it's been through the ringer, passing one stress test after another. Just look at this timeline. In only 5 years, we've had 6 massive shocks. Any one of these was supposed to be the thing that finally broke the economy. You had the COVID shutdown, total supply chain chaos, then runaway inflation, followed by the fastest Fed rate hikes in history. I mean, before each of these, experts were lining up to call for a recession. And yet, here we are. We survived every single one. And this right here is the kicker. After weathering 6 storms that were supposed to sink the ship, the market is actually cheaper today than it was before all of it started. The PE ratio, which is just a fancy way of saying how expensive stocks are, is lower now. You'd think after proving how resilient it is, the market would be more expensive, right? Not less. Okay, so we've established the foundation is solid, it's resilient. Now, let's talk about what's going to build on top of it. First up, the AI supercycle. Now, according to Tom Lee, the whole AI boom isn't just about hyper-cool new chatbots. It's happening because it has to happen. It's a solution to a massive, fundamental problem that the entire world is facing right now. And you can see that problem right here on this chart. For the first time in half a century, since 1973, the world's population is growing way faster than the number of people in their prime working years. Look at that gap. For basically 2 generations, businesses could always find more workers. That's just not true anymore. We have a structural shortage of people. And that leads to a really simple conclusion. If you can't find enough human workers, well, you gotta find non-human workers. This shortage is forcing companies to pour money into AI, into robotics, into automation. It's creating what they're calling a supercycle, where tech spending just goes vertical. And guess who's at the center of it all, supplying the world with this tech? The US. Now, I know what some of you are thinking. Isn't this just another tech bubble? Well, let's put it in perspective. Look at NVIDIA. They make the chips that are literally the engine of this entire revolution. Their valuation? A PE of 26. Now look at Costco. Great company. We all love it. They sell toilet paper in bulk. Their valuation is almost double NVIDIA's, at 49. It just makes you wonder, is the AI trade really overvalued, or is it just getting started? All right, so AI is massive, but it's not the only game in town. There's a second technological wave coming, and this one is aimed squarely at the plumbing of the entire financial system, blockchain. To really get this, we've got to rewind to 1971. That's the year the US dollar stopped being backed by gold. It basically became an idea, a synthetic asset backed only by trust in the government. To make that work, Wall Street had to get creative. They invented all these new financial products, ETFs, money markets, that made this new kind of dollar the center of the universe for global finance. Okay, now let's jump back to today. Blockchain is the next big step in that evolution. Forget all the complicated jargon. Just think of it as a public software that makes financial transactions instant and cheap. It gets rid of all the friction and costs that banks deal with every day. It lets everything of value become digital and synthetic, not just the dollar. And we're not just talking about crypto here. This is way bigger. Wall Street is building the rails to put every single asset you can think of on the blockchain. Your stocks, your credit, even your house. They're talking about tokenizing intellectual property. For the financial industry, this is one of the biggest opportunities for profit and efficiency they've seen in a lifetime. All right, let's pause. We've got a resilient economy. We've got two huge tech revolutions happening. So it brings us back to that first question. Why does everyone feel so bad? Why all the pessimism? Well, Tom Lee's analysis points to a pretty provocative reason, and it comes down to politics. Now, this table shows that while the country is split pretty evenly, the key institutions that shape how we think about money, they're not. The media, the Fed, they lean heavily Democratic. Same with the stock market and VC world. The bond market, on the other hand, leans Republican. So the theory here is this. The people who talk the most about the stock market might be looking at the economy through a negative political filter. Meanwhile, the bond market, which is often called the smart money, has been pretty chill through all the recent crises. It acted like everything was fundamentally fine. So, according to this view, that political divide might be a huge reason for the disconnect between the market's performance and the public's mood. Okay, so that brings us to our last and maybe most important point. With all this negative talk, it's really tempting to just sit on the sidelines and wait for things to feel safe. But doing that has a massive hidden cost. Let's start here. If you just bought the S&P 500 back in 2015 and held on through everything, you'd have made a really solid 12% a year on average. But here is the crazy part. If you got scared and tried to jump in and out of the market, and you missed just the 10 best days each year, your return doesn't just go down. It flips from a 12% gain to a 10% loss. Think about that. All the gains happen in just a tiny handful of days. And that just shows you how dangerous it is to let your feelings or the headlines guide your investment decisions. So it leaves us with one final big question. In a market that everyone seems to hate, is the biggest risk not what might happen, but what you'll miss if you're sitting on the sidelines?